Hello and welcome to Pro Trader Strategies. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal. I'm here to teach you guys some different option strategies that you can then implement into your portfolios, but please do that in your own way. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data. Today is the first Friday of the month. You know what that means? Unenjoyment Friday. It's the non-farm payrolls. We got our average hourly earnings coming in at 0.2%, expected to be 0.3%. They revised last month's number up from 0.1% to 0.2%. So the revision makes up for the miss on the headline number. We also want to start seeing that hourly average earnings to start moving higher, right? Because that gives demand to the consumer to use that cash to buy more products and goods. We are seeing a pretty good economy, so we would start to expect this to unfold a little bit better. Non-farm payrolls knocking it out of the park. 263,000 hires, expected to be 181,000 hires. They did revise last month's number down by about 10,000, but not nearly enough to make the headline number look bad at all. 196 to 189. So they've lowered it by 6,000 hires. Not anything like the beat that we got by about 82,000 this month. And then we got unemployment rate coming in at 3.6%, expected to be 3.8%. That is the lowest level since I've been alive, you guys, and I'm an old friggin' man. Well, not really that old, but December of 1969 is the lowest reading we've ever gotten, and this is the lowest reading we have gotten since December of 1969 is what I should say. I was born in January of 70, so I just was the baby that created that. Maybe I don't know where I'm going with that. All right, anyway, preliminary wholesale inventories. We were seeing these inventories start to build a little bit. Now we're seeing them come off, coming in at unchanged, expected to be a 0.2% raise. And then we got non-manufacturing ISM, Institute for Supply Management. This is our major number for the non-manufacturing. That's really just saying service sector. PMI, Purchase Managers Index, coming in above 50, which is expansion. And it came in at 55.5, although it is lower than the expected 57.2. And then we've got a plethora of FOMC members speaking today. We've got Evans, Williams, who else was it? Bullard, Bowman, Williams, and Caleri, somebody else. Anyway, I can't pronounce her name right now. Anyway, overall markets, everybody's happy today because all the markets are in positive territory probably. Anyway, we've got crude oil slightly moving higher today. I'm expecting this crude oil, to roll over right and stay right around this $63 a barrel area. Try and fill in some of this little low volume node that we're seeing here. That's what's happened. So I have been talking about this rally when we came up and started testing this Fibonacci, the 66 area. We failed several times. I was talking about this, that we were looking to roll over and go back down to that 63 mark. That's what's happened. Now we're starting to see this is the 200-day moving average. We got the 200-day simple moving average right there. And then we've got the 50-day here. This is the simple moving average. I'll put the S in there. And once we see these two cross over like that, that becomes more bullish as soon as the 50 goes over the top. So that becomes a bullish pattern and starting to look to move higher. I think we're going to kind of stay down here a little bit, maybe bounce around, even test this 58 barrel. That would be what I would expect before we start to see the rebound back up to the point of control. Although that theory may, not hold very much weight because of the good economic data, and people are going to expect with the economy doing rather well, better than expected, doing with regards to unemployment, manufacturing, all of that stuff, that the overall economy is doing well enough to rebound. That would cause people to think that there is going to be a larger demand for oil. And if there's a larger demand for oil, that should drive prices higher, okay? So that is the thorn in that or the chink in that armor for that theory. Then we go over to gold futures. They are blasting off higher by about $10 right now, back above 1280. Looks like it's going back to that 1300 area, that 1290, 1300 area where this point of control is. It's a magnet. So I think it's looking like it wants to go back to that area because for no other reason than it's a magnet right there. You'd think with the economy doing well, we're not really seeing inflation, that gold would be one of those assets that we're suffering today, people pulling money out of gold and putting it into more riskier assets like the equities. We're not really seeing that today. It's a lot of influx of money maybe that was on the sidelines getting put to work now. And then we've got the bonds. Again, why are the bonds moving higher? Bonds moving higher and it indicates lower interest rates. We've talked about that, right? It's the teeter-totter. As interest, or as the bonds go higher, interest rates should go lower. And we aren't going to probably see lower interest rates with the economic data points that we're getting out. The economy is doing okay. I talked about this. It's not super robust. We aren't like, going gangbusters right now, and we aren't in a recessionary time. Although this is, if we make this period of time all the way through, I think it's either June or July, it will be the longest period in time that we've gone without having a recession in there. So this has been a long expansion. What could go wrong? Well, a lot of these things could go wrong, but right now we're not seeing any signals that is really saying we are turning around and looking for a recession, as far as I'm seeing anyway. So bonds, I think, should be rolling over back down to the point of control around that 145 handle. 145 even is probably where I believe it should go. That's where the point of control is. And this is where the most time and volume has been spent for the better part of the year, right? Because that's where the market's expecting the interest rates aren't going to move. And I would expect us to come back down and start playing around in that area as well. And then we move over to the VIX. VIX is coming off, obviously, because everything's moving higher. We've got the Dow Jones Industrial Average up about 130 points. I would expect this. That was a great economic data point. As a matter of fact, I'm a little surprised that equities aren't rallying more than what they are at this point. So Dow Jones up only about 130 points. I'm expecting these markets to start making that turnaround and going for the highs again. The NASDAQ, my whole theory with this rolling back over now, I think is out of the realm of possibility. The economic data point, if we had a bad economic data point, I think we would have come back down to the value area and come back into this point of control area. But with this data point, I don't see any reason why this market can't start moving higher now at this point. And there's nothing really holding it back, to be quite honest. E-mini S&Ps got that little bounce. This usually is a continuation pattern when we see a pattern where we get that kind of candle where it's right in the middle and right after we had that big red candle, right? That's usually an indication that this should continue down. That's just a pause usually. But what we've seen here today is that this market has acted as a bottom and looking to rebound higher. And like I said, technicals and everything else out of the realm right now, or out of the thinking. I think that the economic data is going to push these equities higher. So off to the races. I'm just surprised that some of the other levers and pulleys of the market aren't really following through, with the bonds coming off, gold coming off as well. All right, we can see this on the economic data. Yesterday's been a pretty wild ride. This, and not unexpected. Remember, we talked about this area here is like when you have that little airplane where you kind of have your airplane where you have that little propeller on there and it's got a rubber band attached to a little hook here, and you twist that rubber band on the propeller up. Well, the more you twist that rubber band, the more we start seeing, it's a pretty good airplane, right? The more we start seeing that tension build up in that rubber band. And when you let go of the propeller, it spins really fast if you really tightened it up. And that's what we were seeing here. The longer we see something trading in this range like this, it's like that rubber band getting wound up. And I talked about this. We got the snap back down, another snap. So that's that rubber band unwinding. Now we got the economic data and we are popping to the upside. So that, I believe, is going to continue. We might see a little bit of choppiness, but for the most part, I think the equities and even the mini S&Ps could look to go for those highs next week, most likely. I would have to say, unless we get bad economic data next week, this market, the risk is to the upside in equities and to the downside in bonds. All right, that's all I got for you guys. I hope everybody has a great weekend. And if you can't take that, take it easy.